Are you a business owner trying to decide what business structure is right for you, an LLC or an S Corp? You've come to the right place. Getting the right entity set up can save you thousands in taxes each year. So it's important to understand the key differences. Getting it wrong can cost you thousands in unnecessary taxes and legal headaches down the road. That's why in this video, we're deep diving into the key differences between LLCs and S Corporations. By the end, you'll know exactly which one is best for your business situation. This is crucial information whether you're just starting a new venture or looking to change the structure of an existing business. So get ready to take some notes. Let's start by looking at the LLC, or Limited Liability Company. An LLC is a legal business structure that combines liability protection of a corporation with the tax simplicity of a sole proprietorship or partnership. The limited liability part means the owners, called members, are not personally responsible for the company's debts or liabilities. So if the LLC gets sued or goes bankrupt, the members' personal assets like houses, cars, and bank accounts are protected. This liability protection is a huge advantage over being a solo entrepreneur or running your business as a sole proprietorship or general partnership where your personal assets are exposed. From a tax perspective, LLCs are very simple. They are considered pass-through entities, meaning the LLC itself doesn't pay federal income taxes. Instead, the profits and losses pass through to the members' personal tax returns, where they get taxed at the individual rates based on their ownership percentage. So in summary, LLCs provide excellent liability protection, simple pass-through taxation, avoiding double taxation, and flexibility in profit-loss allocations, all with minimal administrative burden. Those benefits help explain why LLCs have become the most popular business structure for small businesses and startups. Unlike an LLC, which is its own legal business entity structure, an S Corporation is a tax status elected with the IRS. It gets its name from Subchapter S of the Internal Revenue Code that details the special tax treatment. Certain qualifying corporations, or LLCs, are eligible to make an S Corp election, with the IRS to be taxed as a pass-through entity like a partnership rather than a regular C corporation subject to double taxation. So from a legal entity standpoint, an S Corp is either 1. A corporation that elects S Corp status, 2. An LLC that elects to be taxed as an S Corp. Similar to an LLC, the big advantage of an S Corp is avoiding the double taxation issue of regular C Corp. All of the S Corp's income and losses pass through to the owner's personal returns, where it gets taxed at individual rates based on ownership percentage. While the key difference between an S Corp and an LLC is in how the owners get paid and pay taxes on that income. For LLC owners, all of the company's net income passes through to the owner's personal returns as self-employment income, subject to self-employment tax of 15.3%. But with an S Corp, the shareholder employees are considered employees of the company. They must receive a reasonable compensation, salary from the business, subject to normal payroll taxes. Any remaining profits get distributed to shareholders as dividends, avoiding the self-employment tax hit. We'll dig more into how owner compensation works with S Corp and the tax advantages it provides in just a bit. But first, let's discuss some of the other key differences between LLCs and S Corp. So here are some of the other key differences. 1. The ownership rules. While LLCs have no restrictions on the number of members or types of members, S Corp face some limitations, such as it can have a maximum of 100 shareholders. Shareholders must be individuals, certain trusts, or estates. Cannot have any non-resident alien shareholders. 2. The administration and compliance. LLCs have minimal corporate formalities or compliance requirements, while S Corp face more stringent rules, must have bylaws, directors, annual meetings, meeting minutes, etc. Higher administrative costs for additional compliance. More expensive to set up initially due to incorporation requirements. So in terms of simplicity and lower admin or compliance burden, LLCs have a clear advantage over S Corp. But S Corp make up for it with some valuable tax benefits when structured properly. 3. The self-employment tax savings. This is where S Corp can potentially save business owners a significant amount of money over an LLC structure. It all comes down to how the owners get paid and taxed on that income. If you're self-employed or an LLC owner, you must pay a 15.3% self-employment tax on all your net business income. This covers the employer and employee portions of 12.4% Social Security tax on the first $142,800 of income for 2022, 2.9% Medicare tax. So if your LLC nets $100,000 in profit for the year, you'll owe $15,300 in self-employment tax on that entire amount. Youch! But with an S Corp, the owner also becomes an employee who receives W-2 wages from the business. Only the wages or salary are subject to payroll taxes, not all the net business income. Let's look at an example. Say your S Corp nets $100,000 in profit. As an employee, you pay yourself a reasonable salary of $50,000. You'll owe payroll taxes of 7.65%, your portion, on that $50,000 salary, which is $3,825, but the remaining $50,000 in profits can be distributed to you as the shareholder, and those distributions avoid the 15.3% self-employment tax, though you'll still owe income taxes on them. So in this example, the S Corp structure could save you over $11,000 in taxes compared to running that same business as an LLC. And the more profitable your business becomes, the greater those self-employment tax savings grow when structured as an S Corp versus an LLC. This difference in how business income gets taxed is often the driving force behind why many entrepreneurs choose to make the S Corp election. 4. S Corp reasonable salary requirements. While S Corp allows you to take some profits as distributions to avoid self-employment tax, the IRS isn't just going to let you take all the profits that way tax-free. There are strict rules requiring S Corp shareholder employees to pay themselves a reasonable compensation salary that is subject to payroll taxes. The salary needs to be fair market value based on the services the owner provides to the company. Things like training, experience, duties performed, business financials, and comparable wages paid by similar companies all factor into reasonable compensation. If the IRS audits your S Corp and deems the salary as too low compared to the work performed, they can reclassify additional distributions as wages subject to payroll taxes, plus potential penalties and interest. There's no hard percentage to calculate a reasonable salary, but many tax professionals recommend paying at least 50% of the S Corporation's total net income as W-2 wages to stay out of the IRS crosshairs. So you can't just max out on distributions to avoid payroll taxes entirely. There needs to be a balance between paying yourself a reasonable salary first. 5. Additional tax filing. LLCs simply report their income and expenses on the owner's personal 1040 tax returns using Schedule C S Corporations. It must file a separate corporate tax return, Form 1120S, annually, in addition to the shareholder's personal returns. While not overly complex, right? The 1120s is another compliance requirement and potential added cost if working with an accountant. 6. Risk of termination. The S Corp election can also be terminated. If the company fails to comply with the requirements around number of shareholders, types of shareholders, one class of stock, or other rules defined by the IRS. This termination would mean reverting back to being taxed as a C corporation subject to double taxation until a new S Corp election could be made. So in exchange for the potential tax savings, S Corp do require quite a bit more administrative upkeep and compliance compared to the simplicity of an LLC structure. This additional time, cost, and general hassle is a major consideration. Enough of the comparison, so which one is better, LLC or S Corp? At this point, you hopefully have a solid understanding of how LLCs and S corporations differ in their legal structures, taxation of owners, and compliance requirements. But which one should you actually choose? Like many tax or legal decisions, there's no one-size-fits-all answer. The right structure depends on your specific business situation, priorities, and growth plans. Here are some general guidelines that might be helpful. Choose an LLC if you're a smaller, newer business generating modest profits. You prioritize simplicity and minimalism, compliance over potential tax savings. You don't mind paying self-employment tax on all income. For many smaller businesses or startups, the added hassle and compliance costs of an S Corp simply aren't worth it yet. The self-employment tax hit is likely lower than the cost of operating as an S Corp until you reach a certain profit level. LLCs provide an easy, flexible structure with good liability protection and pass-through taxation on your individual returns. The simplicity allows you to focus on growing your business instead of admin work. On the other hand, choose an S Corporation if your business is already profitable, e.g. over $70,000 to $80,000 net. You want to maximize tax savings by avoiding self-employment tax. You have the resources to handle reasonable salary and compliance rules. The more profitable your business becomes, the more likely you'll benefit from making the S Corp election, avoiding the 15.3% self-employment tax hit. On distributions can generate significant tax savings once you reach higher income levels. The potential savings from S Corp status typically start outweighing the added costs and compliance responsibilities. Once your business nets $70,000 to $80,000 or more annually. However, this can vary based on your unique situation. Many business owners start as an LLC and only later convert to an S Corp, once the tax savings become worthwhile compared to the added S Corp responsibilities. There you have it, folks. Everything you need to know about the key differences between limited liability companies, LLCs, and S Corporations. Let's quickly recap this difference. LLCs provide liability protection and simple pass-through taxation, while avoiding double taxation, all with minimal administrative burdens. This simplicity makes LLCs ideal for smaller businesses or startups. S Corporations also provide liability protection and pass-through taxation, but allow you to save on self-employment taxes. If you need professional assistance setting up your LLC or corporation, check out the link in the description for zenbusiness. Their affordable packages take the headache out of business formations. Thanks so much for watching. I hope this gave you a thorough understanding of LLCs versus S Corp, so you can choose the best structure for your business needs. If you have any other questions, drop them in the comments below. And finally, don't forget to give this video a thumbs up if you found it helpful, and subscribe to the channel for more invaluable business tips and entrepreneurial advice. That's all for now. Catch you next time.